Welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of all those mixed messages regarding the property markets. We want them to develop financial freedom that they're looking for. And today I'm joined by independent financial advisor Stuart Wemyss, founder of Pro Solution Private Clients. And I want to ask him how property investors can maximise their returns. Let's find out how, in this ever-changing property market that we're experiencing, how you can ensure that your investments aren't just performing, but they're thriving. How do you make the right choices, avoid costly mistakes, and set yourself up for long-term financial success? If that's what you're looking for, let's jump in and learn how to make every dollar of your property investment work harder for you.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Stuart.
Hey, Michael. Thanks for having me back again.
Now, Stuart, you recently wrote a blog and you published a podcast about this. And in fact, you even discussed this in the Australians podcast as well, about how property investors can ensure they maximise their investment returns over the long term. So I'd like to ask you some questions about that. What inspired you to write this article and to put together this information?
I was almost a full bottle into a dinner I was having with a friend. And that's not just my bottle, but we shared a bottle of wine. And he runs a commercial property business, and he just made the observation that investors, he said to me, in fact, the sentence was, investors don't really understand internal rate of return. Anyway, and it just sort of sat in my head, and I thought about it for a while, and I thought, yeah, it's a really good point, because it's a very important mathematical calculation. You don't really need to know how to calculate necessarily, and you don't even really need to go and calculate it per se, but I think it's critical to understand the calculation and the inputs to the calculation, because it's all about allocation of capital and the best allocation of capital, which is all we really want to know, is that I've got some borrowing capacity, I've got some cash flow. How do I best use those two ingredients to build the most amount of wealth over the next 10 years? Well, internal rate of return is a key calculation there. And it's true, most investors don't understand it, particularly property investors, and probably for property investors, even more so than share investors, important to really understand it.
Well, if you use an Excel spreadsheet, it is one of the formulas you can use. I first came across it many, many years ago, maybe over 20 years ago, when PIA Jan Summers had this great program, Property Investment Analysis, and it has an internal rate of return calculation there. So I had to learn 20, 25 years ago what it all means and understand it. And I think you, being an accountant, can explain it better to our listeners and our viewers. But it is an important calculation that we do for our clients, and also particularly for property development as well. So maybe you could just explain, what does internal rate of return show you?
Yeah, sure. Let me use an analogy. Let's say we're going to run a forestry business, which we're going to grow some trees, then we're going to harvest those trees and sell it for the wood. Let's pretend that we obviously need a parcel of land to grow those trees, and we need to go and buy the seedlings to go and plant on the land. Let's say we go and borrow to buy those two ingredients. So we've put no cash in yet because the bank's funded the full cost. But we know we're going to need to water those trees, look over those trees, care for those trees over the next 20 years until they're ready to harvest. And so I'm going to have to pay for the bank interest as well, and the water and whatever else I need to. I've not got no expertise in forestry, by the way. I'm probably demonstrating that. But whatever is required in order to grow those trees. And then in 20 years' time, I'm going to pay someone to go and cut them down and harvest the forest for timber. That's my return. So what I need to then work out is, all over the last 20 years, I've been contributing maybe $10,000 a year to growing these trees. So that's $200,000 over a 20-year period. And then in 20 years' time, maybe I earn $2 million when I harvest the forest. That's my return. So I need to work out was it worthwhile putting that $10,000 towards this forestry investment? Or could I have done something different with the money? Maybe I should have put it into super or put it into the share market or gone and bought an investment property. That's the internal rate of return. It expresses the return that I've earned on my capital that I've contributed over the last 20 years in a compounding percentage. And that's key, because then I can work out if it's 15%, then I can go, and my super's done only 8%, I'm miles in front. It's a better investment. So that's what it shows us. And we'll talk about the components in a second.
Well, what it shows you is really the return over time. What would you rather have, $100 now or $20 a month over 10 years? So this also takes into account, if I understand correctly, the time value of money. So as a property investor, you put a deposit down, you pay some stamp duty and other costs, and then every year you put some money in, you get rent coming in, you put some money to cover your costs, at the end of which you may choose to sell. We don't like selling, but at least you do the sum. Okay, if I sell and pay capital gains tax, this is the internal rate of return on my money over that time, as opposed to the internal rate of return with other potential investments, whether they're other properties or other investment classes. But so that takes into account capital growth, but also income rental return along the way. Now, unfortunately, we both know that a lot of beginning investors place more emphasis on cash flow because they want or they need the money, or they don't have the cash flow. But that's not really how residential real estate works, is it?
No, because you've got to think about your contributions, your capital versus your return. So as you said, Michael, your contribution is funding the negative cash flow. When we go and borrow the full cost of a property, the expenses are always going to be more than the income. So of course it takes money out of our pocket. We've got to contribute each month to the negative cash flow. Now, if we buy a really high yielding property, that means it should hopefully turn positive a lot quicker, but it still might take a bit of time, 10, 15 years for it to turn positive in terms of positive cash flow. Now, if it turns positive cash flow, it's actually then giving us an income return, albeit probably small after expenses, but that's part of our return. The other part of our return is the capital growth. So if we go and sell that property in 20 years, repay the loan, pay for selling costs and pay for capital gains tax, at the end of the day, after all that, it's going to put some money in my pocket. Now, it's good it's possible to try and find a property that's high yielding, which means I need to contribute less of my capital. The question you need to ask, though, is at what cost? Because does that mean that type of property will put less money in your pocket in 20 years' time? Now, as you say, Michael, we don't necessarily want to go and buy and sell in 20 years' time. We can't take the assets with us. We're going to enjoy them at some point. That's the whole point we build wealth and undertake financial planning. But this calculation is still important, even if we don't intend to sell the property, because it is all about the best use or allocation of our capital and just understanding how that all works.
Now, one of the themes in every discussion we have is taking a long-term approach, not getting caught in the white noise, the short-term ups and downs. Don't make 30-year investment decisions on the last 30 minutes of news. But in the short term, a lot of beginning investors have a cash flow issue. So how do you balance the cash flow challenges with the long-term capital growth strategies to achieve the best outcome?
It's all about getting the highest return for your contribution. So if your cash flow is thin and small, that's okay. It's just about what is the best use of that cash flow. If you have oodles of cash flow and in a fantastic income position, that's great too, but it's still about what's the best return of your cash flow. So if I've got $5,000 of free cash flow per year, and I expect to have that over the next 20 years, the key question I want to ask myself is, how do I turn that into the biggest pot of money in 20 years' time? That's really the internal rate of return. And maybe I can demonstrate it, Michael, by using a couple of different examples.
Yes,
so
please.
what I looked at is a property that returns 9% in total. And the difference between the scenarios is really just the components of that return. So income versus capital growth. So if we look at the traditional blue chip property that's low yield, high growth, let's say it's a low rental income yield of 1.5% and 7.5% of capital growth, resulting in a total return of 9%, of course. The internal rate of return of that investment is 10.5% on an after-tax basis. Okay, that's not too bad. If we look at a high yielding property, so the example would be 5.5% in terms of rental yield, but therefore only 3.5% growth, again, total return of 9%. The internal rate of return is 10.3%, almost identical to the low yield, high growth property. Still a pretty good return, better than really super has been over the last 20 or 30 years, so long term. The key difference, though, so you would argue, well, Stuart, the high yield or low yield property, either or of those are going to be good because the internal rate of return is great. But when we compare that to the net sale proceeds, so if I held the property for 30 years and then sold it, what would the cash that I'd walk away after paying for all expenses and taxes be in today's dollars? Well, for the high yield property, the cash that I'm going to get is $650,000 in today's dollars. Not a small amount of money, pretty good. Like no one's, if I put 650 grand in your bank account, Michael, you're not going to hate me for it.
No,
It's
I'd be
not a
happy
bad
to
sum
think
of money. But if you compare that to the high growth, low yield, high growth property, $2.8 million. So
Wow.
here we go. We've got the same internal rate of return, the same sort of capital contribution. I would need to buy 5.5 high yield, low growth properties to generate the same level of wealth. And so that's why I think it's such an important calculation to understand and understand how the return is driven, because it's really about in 20 or 30 years' time, you want to look back and go, well, I made the wisest decision with my surplus cash flow. I did what I could do. Now, for some people, that's not invest in property. Maybe super is a better option for them. But if they're going to invest in property, you have to understand what you essentially need to do is reduce your holding costs as much as possible, but without taking a haircut on the capital growth, which is the payday that you will eventually enjoy. That's the element you certainly want to maximize. And I believe that property investors can do that in sort of 2 steps.
So, from what I hear, it's essential to not compromise on capital growth. That comes number one. And then once you own the property, what you're suggesting is be cautious about expenses as well. You're not saying be stingy. You're not saying let it fall apart. And in fact, I know you keep your properties up to date and you renovate properties, which is another interesting way we look at internal rate of return. Maybe 5-10 years later, you have to put in substantial amounts again to new carpet or repaint the property. How can investors understand how it's working, how their properties are working? Are they getting a good return? How can they monitor this?
So I think it's about obsessing before you buy the asset on capital growth. Like when I say obsessing, that is your only concern. Within your budget, buy a property that is going to have the highest average capital growth rate over the ownership period, which again, you hope is 10, 20 years, whatever it might be. Now, people say 20 years, that's a long time, Stuart, but 20 years goes by pretty quickly in my
Boy, does it,
experience.
yes.
And you'll thank your previous self for making that decision in 20 years' time, making that good long-term decision. So that's the key thing. Now we've got to then understand the attributes of that property. It means that we need a strong land value component in a location where land supply is fixed and finite, that's in very high demand. So it's really about quality of land, and then it's about quantity once we've ticked the quality box. And you can't really change that, right? You can't, I mean, suburbs and locations can gentrify and change over time, and they do, but it can take many decades. But there's not much, if you end up buying in the middle of nowhere, there's not much you can do to sort of change the potential capital growth prospects of that asset. But once you've made that initial acquisition, you should then forget about capital growth because that's locked in. You've made that decision that's going to determine what the growth is going to be. You should then just obsess about cash flow. And the goal should be, I want to contribute the least amount into this investment. Of course, Michael, as you said, that doesn't mean not completing maintenance of property, because ultimately that's just a false economy. You're actually going to take a haircut on rental income growth and vacancy and all these sorts of things. So, but it's really, and sometimes it means spending more money on property, like renovating and completing cosmetic improvements. That often improves your cash flow position because you can borrow to fund those costs on a tax deductible basis, which is going to reduce your tax and then also give you some depreciation. So it's not just about minimizing any expenditure on the property, but it's ultimately minimizing your after-tax cash flow that you're contributing towards the property. And quite often, Michael, particularly over the last couple of years where interest rates have risen so much, a lot of investors are sitting back and going, look, I'm paying all these bills, all this money, I get a land tax bill and all this money is going out the door. Am I going to get a return? Great question. And I think the key thing to really think about is how much, if I've got a pre-existing investment, how much is that investment costing me per year? What do I think that investment is going to be worth in 20 years' time? What's the internal rate of return? And should I continue to hang on to this property?
Now, I know at Pro Solution Private Clients you have accounting services, financial planning, and also a mortgage arm. How do different borrowing structures, interest only, principal and interest, those things impact on the long-term returns? What advice do you give your clients?
Well, remember, it's about minimizing the amount of capital you're putting in, because if I minimize the amount of capital I put into an investment, it means I've got more capital to invest elsewhere, whether that is to repay my non-tax deductible home loan or to make additional contributions into super or the share market, whatever it might be. But I really want to minimize as much as possible any contribution into the property. I mean, it depends on your age and stage of life, of course. So that really means paying interest only rather than principal interest, because if I'm paying principal interest, it actually means that I'm paying the loan down, I'm reducing its principal balance, and therefore putting in more of my own capital, which may reduce the holding costs, yeah, but it's putting more capital in, so it doesn't necessarily improve the internal rate of return. What improves the internal rate of return is reducing my contribution, my capital contribution, or increasing the capital value at the end of the day, the actual return, whether that's positive cash flow or a capital gain that I'm going to make when I sell the asset.
The internal rate of return measures the return on the capital you put in. And I know a lot of us were taught to get a good education, get a good job, buy a home, and then slowly pay it off. And so many people are concerned about having debt and they're wanting to repay it too soon. But I believe as property investors, leverage is a very powerful tool, and to repay your debt too early in your journey actually holds you back and doesn't allow you to build a big enough asset base, Stuart.
Yeah, that's right. I mean, it's being too conservative. Like sometimes people think, I just want to minimize the amount I'm paying the bank. Interest is kind of dead money and they're already making nearly $10 million a year. They don't need my money. I get that. But it's really about the best allocation of your capital so that in 20 years' time, you're going to be sitting on the largest asset base possible. That's when you're not really going to care about interest. And so it's just about making informed decisions. Now, of course, it depends on your risk profile and your age and stage of life. So for some people, debt reduction can be an important process to reduce their sensitivity to interest rates, to build in buffers, all those sorts of things. So I'm not talking people out of doing that per se, but really just understanding the internal rate of return. And I guess the other way to put it to people is if I'm going to try and balance out income and capital growth. So if I go back to my example of the total 9% return, and I go somewhere for the midpoint, say 3.5% rental yield and 5.5% growth, which is 9%, that gives me internal rate of return of 9.6. It's inferior to the high growth property and it's inferior to the high yield property. So actually sometimes trying to balance out two things ends up in an inferior position. And so quite often people, particularly investors that aren't experienced, will say, look, here's two different property assets in different locations. One's going to cost me a lot less money. Let's hope that the capital growth between the two are equal. I'm going to buy the property that costs me less money on an annual basis. The problem with that is that what you'll have to do to make that internal rate of return work is you've got to assume then you're going to get a high rental yield and a high capital growth on average over a very long period of time. Those things can occur in short periods of time, particularly as prices change or areas gentrify or change or those sorts of things. But I wouldn't be building an investment strategy on the assumption that I can generate a 13% total return, let's say 6.5% income, 6.5% growth over, say, a 20-year period. I mean, if you want to be that ambitious, you want to be buying in a location like Point Piper in Sydney or something like that, where it's, the best property in Australia. But unless you're buying in that location, I think being conservative with what long-term returns that you can expect, and then working out what are the proportions of those returns that are going to, build the most amount of wealth for me over the next period of time.
I guess a lot of beginning investors are looking for cash flow. They're thinking about the here and now rather than the long term, as you keep mentioning. They're buying properties that may solve a short term problem, but I think the message from our chat today is it won't give them the long-term results they're hoping for, where we're looking for capital growth. And again, others are worried about how am I going to service the debts? Well, I know your team at Pro Solution Private Clients actually take into account buffers that help buy clients, property investors, buy time as well as property. So they want more choices in life with cash flow. But I think people need to build an asset base first. And then once you've got a big asset base, down the track, you can get the cash flow you want, the choices in life. It's got to be done in the right order, doesn't it?
That's right. And that's why the internal rate of return is so important to property investors, because typically most property investors don't contribute any capital at the beginning. So the only capital they're going to contribute is, what the property costs to hold that property over a couple of decades. And quite often, as we've just said, like the false view is, well, let's try and minimize that as much as possible, thinking that it's not going to come at a cost of the future capital growth. But it inevitably does, because average returns can't be really higher than 8 or 9%. Let's call it 8 to 10% if you like. Now, if you want to be really aggressive, let's assume a 10% return, but not more than that. So it means that you're either going to have a property that's high growth, low yield, or high yield, low growth. But targeting a property in the middle clearly is inferior. You've got to choose one or the other. And hopefully what today's episode has shown is that low yield, high growth property, whilst the internal rate of return is relatively similar to the high yield one, it's the money at the end of the day that property will put in your pocket in 30 years' time when you sell the asset. That's the key factor that separates those two assets.
Now, you're talking from many years of perspective, as am I, but a lot of people are seeing on social media that you can get both, and people want cash flow, so there's people out there teaching cash flow, so to speak. But if you do, you're going to end up getting the same results that most investors get if you do what they do, and we know what most investors get. 50% sell up in the first 5 years, and the ATO statistics show that 92% never get past their first or second property. So while it may give you a short-term advantage with a little bit of cash flow that you pay tax on, you're not going to build the asset base that gives you choices later in life. So do the hard things now to have the easy life later. Now, Stuart, what I think you've demonstrated in our discussion is your depth of knowledge about property. And this comes from the sort of services that you provide your clients at Pro Solution Private Clients. I enjoy getting a weekly podcast on Investopoly podcast on Wednesdays in your blog, but maybe you could just tell people watching this or listening to this what you do and how you can help clients.
Yeah, sure, Michael. We offer taxation, financial planning, and mortgage broking services on a holistic basis, which means that we build a long-term strategy for our clients, and then the one team, with the one multifaceted team, help them implement that strategy and then navigate the inevitable changes in their life. And we're asset class agnostic, which means that we don't care if it's all property, all shares. We think that most people probably should be investing in both, but we've got nothing to sell you, and we've got no allegiances or thinking that one is better than the other. It really is just holistic advice to ultimately help you build wealth.
Well, Stuart, thanks for your time once again. It's the first show for 2025 that we're doing together, and I look forward to having you back once a month in 2025, because clearly you've got a great depth of knowledge and perspective. Catch up with you again soon.
Thanks, Michael. Looking forward to it.
Stuart always brings great information to these podcasts, doesn't he? And I hope the message you got was that despite all the mixed messages in the media, despite a lot of people feeling uncertain about what's happening, the fundamentals for property for 2025 sound, and there's good opportunities for those who are in the right financial position to take advantage of them. Now, I don't know your personal financial position, and that's why I can't give you any advice. What I do know is a lot of people finished 2024 disappointed that they didn't take advantage of the market because there was all this information they got on the media, too many opinions, too little clarity. They were worried about making a mistake. There was issues about mortgage crisis and all those cliffs that we never fell off. So why not get some clarity, have a clear plan? The solution to wealth is to start with a plan and then implement the plan. And that's what we help our clients do at Metropole. We're much more than buyer's agents. We help our clients safely grow, protect and outperform the markets and pass on their wealth by starting with strategic property and wealth advice. We help you define your goals, make sure they're realistic, and then we use very powerful software that you have access to track your progress, to maximize your wealth creation opportunities, but also identify and mitigate risks. So a property strategist's job is to stop you making mistakes. So we're much more than buyer's agents. We have a very significant buyer's agency department, and we're happy to manage your property in the long term. We'll help you accumulate your wealth. But first of all, we've got to help you plan to become the person you plan to become. So why not go to metropole.com.au and have a complimentary wealth discovery chat with one of our property wealth strategists. Metropole.com.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like you to imagine you've got a thorn in your arm. Now, this thorn is piercing on a nerve, and just the slightest contact makes pain shoot right throughout your body. So in order for you to live without pain, you make every attempt to ensure nothing touches the thorn. You create a pad to protect your arm. It's not comfortable to wear, or definitely not comfortable to sleep with, but you put up with it to prevent the pain. Plan every area of your life so that nothing touches the thorn, and you pull all your energy and focus on how to be free from troubles with the thorn. But are you really? Now, interestingly, in the book The Untethered Soul, author Michael Singer uses this analogy to show that in reality, all this person has done is cover up the problem. By doing so, they've built their entire life around the problem. Of course, the alternative is simply to remove the thorn, isn't it? Look, we've all got internal thorns that we've built our entire lives around. We bury our childhood traumas, our fears, our emotional insecurities. Whenever something touches these thorns, rather than letting them rise to the surface, experiencing them and facing them head on, we bury them deeper by distracting ourselves from the pain, by convincing ourselves it's not there. You're not your fears. You create your fears. Why is it that some people are scared of the needles and bloods, and yet doctors and nurses work with them daily? Some, I don't know, I guess the same goes for snakes, for spiders, for door knocking, for cold calling. Depends what business you're in. Here's another thorn many people have. The fear of rejection. But the fear of rejection is just a notion. It exists in itself. You can't fill a bucket with rejection. You create the fear by giving it meaning. I remember Jack Canfield saying everything you want is on the opposite side, the other side of fear. So my mentorship message today, my mindset message for you today is it's time to have a brutally honest conversation with yourself. What are you afraid of? What's causing your paralysis? What people or conversations have you been avoiding? What would your life look like if you confronted your fears? And if you grew past them, what would your relationships be like? What would your real estate, your property career, your investment career be like? So my mentorship message for you today is you've got two choices. Build your life around accommodating your fears, or number two, face your fears so they'll never bother you again. Pull out that thorn. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?